$500 a month. By 2030, that could be worth over $240,000, and most investors are completely ignoring the exact ETF combination making this possible. There is a specific three-fund structure that institutional investors quietly use, and today I am breaking it down for you. If this is your first time here, this channel is built for everyday investors who want real, actionable ETF strategies without the Wall Street jargon. Hit subscribe and tap the bell right now so you never miss a breakdown like this one. Let me give you the raw math first, because the numbers are what make this strategy impossible to ignore. If you invest $500 every single month starting today and your portfolio averages a 10.8% annual return, which is realistic based on the last 15 years of blended ETF data, you hit $242,000 by December 2030. That is not a fantasy projection. That is compound interest doing what it has always done. The problem is that 90% of retail investors are using a single broad index fund and leaving massive performance on the table. The three-fund structure I am showing you today delivered an average of 12.3% annually over the last decade when backtested together. That extra 1.5% gap sounds small. Over 6 years on $500 per month, it adds nearly $19,000 extra dollars. That's a vacation home down payment sitting uncollected because people chose the wrong combination. So what are the three ETFs? The core position is QQQM, the Invesco Nasdaq 100 ETF. It holds the top 100 non-financial Nasdaq companies, including Apple, Microsoft, Nvidia, and Meta. Its expense ratio is just 0.15%, and its 10-year average annual return sits at 17.8%. You allocate 50% of your $500 here. That's $250 every month. The second position is SCHD, the Schwab U.S. Dividend Equity ETF. This is your stability anchor. SCHD holds 100 high-dividend blue-chip companies with a current yield of 3.5% and a 5-year dividend growth rate of 11.2%. You put 30% here, $150 per month. The dividends it generates get automatically reinvested, creating a compounding snowball inside your portfolio. The final 20%, $100 per month, goes into BLOK, the Amplify Transformational Data Sharing ETF. This is your high-conviction growth kicker targeting blockchain infrastructure and fintech. It is volatile, yes, but positioned at just 20% of your portfolio, the asymmetric upside dramatically improves your total return ceiling without catastrophic downside risk. Now here's where most people make a critical mistake. They set this up in a regular taxable brokerage account and get destroyed by capital gains taxes every single year. The right move is running this strategy inside a Roth IRA. Your $500 monthly contribution falls within the $6,700 annual Roth IRA contribution limit for 2024. Every dollar of growth inside that account is completely tax-free. When you pull $240,000 out in 2030 or beyond, you owe zero to the IRS. Zero. Compare that to a taxable account, where long-term capital gains tax alone could consume $30,000 to $40,000 of that growth, depending on your income bracket. The account structure is not a minor detail. It's the difference between building real wealth and donating it to Washington. Let me show you exactly how the rebalancing works, because this is what separates disciplined investors from the ones who panic sell at the worst moment. Every January, you check your portfolio percentages. If QQQM has surged and now represents 65% of your holdings, you trim it back to 50. You use those proceeds to bring SCHD and BLOK back to their target weights. This is called systematic rebalancing, and it forces you to sell high and buy low automatically, the exact opposite of what emotional investors do. The data backs this up. Portfolios that rebalance annually outperform those that never rebalance by an average of 1.4% per year over decade-long periods, according to Vanguard research. On a $200,000 portfolio, that compounds into an extra $30,000. Rebalancing once per year takes about 20 minutes. That's roughly $15,000 per hour of effort. You should absolutely do this. Here's the scenario I want you to actually visualize. Imagine Marcus, a 34-year-old teacher earning $62,000 per year. He opens a Roth IRA in January 2024 and starts his $500 monthly contribution using this exact three-fund structure. He sets up automatic transfers so the money moves without him having to think about it. He rebalances every January. He does not touch the account when the market drops in 2025 or 2026. By 2030, Marcus has contributed $36,000 of his own money. His portfolio is worth $238,000. That $202,000 difference is pure compound growth working for him while he slept, taught classes, and lived his life. This is not about being a genius investor. Marcus never read a Bloomberg terminal. He just followed a structured plan and didn't quit. The strategy works because it's simple enough to maintain, diversified enough to survive downturns, and growth-oriented enough to build real wealth on a teacher's salary. One final piece that most videos skip entirely: the behavioral firewall. The biggest threat to your $200,000 outcome is not the market crash, it's you. Studies from Dalbar consistently show that the average retail investor earns 3 to 4% less annually than the actual funds they invest in. The reason is behavioral. People sell during downturns and buy back in after recovery, destroying their own returns. Your firewall is this: write down your target date, December 2030, and your projected ending value, $240,000, and tape it somewhere visible. When the market drops 20% and every financial headline screams crisis, you look at that number and you do nothing. Your SCHD dividends are still compounding. Your QQQM is buying discounted Nvidia shares. Your BLOK position is accumulating at lower prices. The crash is not your enemy. Quitting is your enemy. Every investor who stayed fully invested through 2020 doubled their money by 2022. Discipline is the strategy inside the strategy. If this breakdown gave you clarity, smash that like button right now. It genuinely helps this content reach more people who need it. Share this video with one person in your life who's still letting their money sit in a savings account, earning nothing. Subscribe and turn on notifications because next week I'm revealing the one ETF ratio adjustment that could add $60,000 extra to this exact strategy. See you in the next one.